JPMorgan Asset Management Global Head of Fixed Income Strategy, Bob Michele, joins us here at Post 9. Is the Fed going to mess this up, Bob?
I don't think so. I think they want to go out of this year fairly balanced. They don't want to be too dovish and create too loose financial conditions, but they also don't want to be too hawkish and create too much downside here. So they're going to try to thread the needle.
That was the message we got from Powell before the blackout period, right? That there are risks to doing, the risks are more balanced to over-tightening or under-tightening. He said that there are lags and that we haven't felt the full effect of monetary policy tightening. So you expect a similar message, sort of benign?
Yeah.
Would that be a green light though, to keep buying everything, bonds and stocks?
Well, look, the long and variable lags are always questionable when they'll hit. What we do know is that we're in nirvana right now. This is as good a soft landing as the Fed could have taken us into. So I, for one, am going to enjoy it. If bonds back up in yield, I'm out there buying. I think this could be a good week for this. You get CPI, you get auctions, you get the Fed. Maybe we'll be able to buy bonds a bit cheaper.
So you're not worried about any of those event risks as far as the disruption to the bond rally? Auctions, CPI?
I actually want a little bit disruption, maybe get the 10-year towards 4.5 to allow a lot of investors to get in. We talked to a lot of investors, institutional and retail. They're all trying to get into this bond market. Of course, everyone wants to buy at a higher yield. It came and went in October so quickly. Now we've got a lot of clients that are trying to chase this.
How long does nirvana keep up for, and what, in your opinion, is going to disturb that? Or most likely to disturb it, I should say.
Well, I do think that there is a rate shock that's been delivered to the system, right? We've had over 500 basis points of rate hikes. It's left things in a very vulnerable position. We're seeing housing has cooled off pretty dramatically. We're looking at the consumer, which is the engine of the U.S. economy, and the bottom 4 quintiles of earners have already burned through most of their excess savings. So unless the Fed is able to find an opportunity to bring down rates over the next 6 months, I think the high level of real yields is what could create more damage going forward.
There was a lot of forensic work done on the jobs number from Friday, basically arguing that we owe much of this year's job creation to government, maybe some private education, healthcare, and leisure hospitality. Do you think that those things, and I know they're big pillars, but that the job market has slowed to a crawl?
It has slowed, and also you had the returning strike workers. What we like to do is look at a 6-month annualized rate, and the 6-month annualized rate is about 130,000 job creations, which is much different than close to 200,000. And then we went back to 2017, 2019, try to get out of the shadow of COVID. And what we found is job creations were about 164,000. So in fact, the labor market is cooling off. You've still got wages running at about 4%. The Fed would like to see 3.5%. But all of this are sort of the elements of a soft landing.
Well, there are two ways that narrative breaks, I guess, on the risk side. Either inflation spikes back up or flares back up, or the economy weakens worse than expected, negative payrolls or a few negative retail sales prints. Which do you think is a bigger risk at this point?
Well, of those tail risks, I think to the downside, and I think
on the economy.
On the economy, for sure. And I think what's kind of slipped through the cracks here is quantitative tightening. And the Fed continues to draw down its balance sheet. Of course, when they were expanding their balance sheet and creating money, it got into everything and inflated the price of everything. You would expect that you would see more disinflation and deflation coming as they draw down the balance sheet, and a good starting point is asset prices.